day, dear listeners. I salute you all. I'm Nathan from Fenina Management Consultants. Today we are going to look at lesson 2 regarding the preparation of a cash budget. Let's start with a revision briefly. We talked about what is a cash budget, and we say that it's an estimation of the cash flows of an entity over a specified period. We also talked about the aim of a cash budget as ensuring efficient allocation of cash resources. We also mentioned the sources of inputs to the cash budget as inflows, such as sales, issue of debt, issue of shares, interest receivable. And then outflows, we mentioned purchases of goods, services, equipment, rent, electricity, tax, as examples. We also talked about the exclusions, that discounts should be deducted from the total sales, which will not be received. Irrecoverable debt should not be included because it's also not going to be recovered. Depreciation, being a non-cash item, should also not be included. This is an example of how to treat discounts, depreciation, and irrecoverable debts. Please remember to hit the subscribe button, give the lecture a like, and give your comments at the bottom. We can be able to provide you with more valuable information. Nathi Engineers manufacture boards, and it estimates 600,000 sales, 150,000 in June, 200,000 in July, and 250,000 in August. At a retail price of $40 per box, the company estimates sales of 5,000 boxes of boards each month. Nathi forecasts that 50% will be cash sales, which will attract a 5% discount. 30% will be collected in the month following the sales. 15% will be collected 2 months after the sale, and 5% will not be recovered. The beginning cash balance for June is forecast to be $40,000. Nathi also projects $200,000 in cash inflows from sales made earlier, 70% of which is receivable in June and the balance in July. On the expense side, Nathi has to also calculate the cost of production required to manufacture the boards that meet customer demand. The company expects 1,000 boxes of boards to be in the beginning inventory and will be paid for in June, which means a minimum of 4,000 boxes must be produced in June. The production cost is $30 per box. 80% of the production costs are payable in the same month at a discount of 5%, and the balance payable the following month. The company also expects to pay $30,000 monthly on costs not directly related to production, such as insurance, office rent, etc. In the month of July, it also expects to buy cash equipment of $20,000 in August. The company policy is to depreciate equipment using 20% per annum straight line with no residual value. Question: prepare a cash budget for the period from June to August 2023. In our first lecture, we talked about the steps of creating a cash budget, which are to check if the entity will have opening cash balance. 2, to establish reliable forecasts for the company's cash inflows. 3, to establish reliable forecasts of the company's cash outflows. And 4, to obtain the closing cash balance for each month using the formula closing balance equals opening balance plus cash inflows minus cash outflows. Here are the workings. We first look at the inflow schedule, and in this case, our inflow is sales. We have the previous month's receivable of 200,000, but 70% is going to be received in June, and 30% is going to be received in July. That's why we see the figures here of 140,000 and 60,000 for June and July respectively. The sales for June are going to be 150,000, of which 50% is receivable in the same month at a discount of 5%, meaning that you are going to receive 95% of the 50% of the 150. And that's why we are saying 150 times 50% times 95%, which gives us 71,250. A month later, we are going to receive 30%. So we multiply 150 times 30% to give us 45,000. In June, we are going to get 15%. The June sales, which are going to receive 2 months later, meaning that they're going to be received in July, in August, it's going to be 150,000 times 15%, which is 22,500. If you add 50% plus 30% plus 15% gives you 95%. And the difference of 5%, which we are not showing here, is the bad debts which are not going to be recovered. July, we have 200 times 50% times 95%, which gives us 95,000. July for August, to be received in August, it's going to be 200 times 30%, which gives us 60,000. And then the one that is going to be received 2 months later, which will be September, because we are selling in July, we're expecting money in July, August, and September. 15% of the 200,000 is going to be received in September. That's why we don't see any figure here. Then let's go to August. The August amount of 250,000, we are going to receive 50%, and we are going to receive only 95% of it in August, which is 118,750. And the balance will be received in future months, September and October, which gives us the totals of 211,250, 200,000, 201,250. Those are the expected receipts from the sales that we are making in June, July, August, plus the opening balance of 200,000 that had been sold but has to be received in June and July. Outflows, in this case, production costs. We calculate the opening units to be paid for and have been given at 1,000. We multiply by the production cost per unit of 35 to give us production cost payable in June of 35,000. Then the manufacture during a month is going to be 4,000 multiplied by 35 US dollars to give us 140, 175, and 175 for June, July, and August. Then the payables for the purchases for June, July, and August are also going to be subject to discount. Our outflows are going to be opening units, which has to be paid for in June, 1,000 times 35, which gives us 35,000. Then the manufacture for June, July, and August of 4,000, 5,000, and 5,000 times 35 US dollars. The outflows in terms of production costs for June, July, and August are going to be as follows. Opening units, which is supposed to be paid for in June, of 1,000 units times 35, which gives us production cost payable in June of 35,000. Then manufacture during the month of 4,000, 5,000, 5,000 for June, July, and August at 35, and 35 US dollars per unit. These will give us 140,000, 175,000, and 175,000 in terms of payables for June, July, and August purchases. Then we need to work out a payment schedule. We start with a 140,000 times 80% times 95% because you are going to get a discount for purchases made in the same month and paid for in the same month, which is, in this case, 106,400 US dollars. And then a month later, it's going to be 140 times 20%, which is 28,000. Then July, we are going to buy 175. We are going to spend 175 times 80% times 95% for July, which is 133,000. Then the one which is payable a month later is going to be 20% with no discount, and is 175,000 times 20%, giving us 35,000. August, same month, is going to be 175,000 times 80% times 95% because it is payable in the same month, which gives us 133,000. The August, which is a month later, will not appear in the August payment schedule because it's supposed to be paid in September. And that's why we don't see that amount in our records. So the totals are going to be 106,400 US dollars, 161,000 US dollars, and 168,000 US dollars. Those are the payables for June, July, and August. But we must not forget that there's an amount for the opening stock, which is supposed to be paid in June. So we go into our cash inflows. Our opening balance of 40,000 plus sales revenue 211,250, which we saw up. If you go back, you're going to see our totals of 211,250 at the bottom here, 200 and 201,250, which are showing here, are going to be our receipts from the sale of June, July, and August, as we calculated. And then that is what we see in our figures that we see here, sales revenue of 211,250, 200, and 201,250. Then we have the cash outflows of 141,400 plus 161 for July and 168 for August. Let's go to our cash outflows. Payment for production costs is going to be 141,400, 161, and 168. The 141,400 is a result of what we saw before of the amount that is supposed to be recovered, mean payable in June of 35,000, plus the total production cost of payables of 140,000. So if the 140,000 is only payables, but now if you look at the 35,000 is supposed to be paid in June, plus 106,400, which is also payable in June, which gives us the total of 141,400. Then the other figures for July and August are just brought up as 161,000 and 168,000. Then non-production payments of 3,000 of each month will just be plugged in without any changes. And then purchase of equipment of 200,000 of 20,000 will also be included in August, as indicated in the question, which gives us our total cash outflows as 171,400 plus 191,000 plus 18,000. And those are now of 171,400 for June. The formula that we use to get the closing balance is going to be opening cash balance plus total cash inflows of 211,250 minus 171,400, which gives us 79,850. Closing balance in June becomes opening balance in July, which is 79,850 plus inflows for July of 200 minus outflows of 191. Then it gives us 88,850, which becomes opening balance in August, plus inflows for August minus outflows for August again, giving us a closing balance of 72,100. In conclusion, a cash budget is an estimate of the cash flows of an entity over a specified period. It is aimed at ensuring efficient allocation of cash resources. The key to accurate cash budgets is to remember that receipts and payments are based on when they will occur. Discounts and bad debts are deducted from the total cash flows. Depreciation is an cash item and must not be appearing in the cash budget. Please remember this. This marks the end of our session for today. The next lecture is going to be more comprehensive, combining the lessons learned in lesson 1 and lesson 2 with case studies that need to be solved. Thank you very much. Please remember to hit the subscribe button, give the lecture a like, and give your comments at the bottom. We can be able to provide you with more valuable information. May God bless you.